Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. Taking Stock, episode 56. It is good to have you back again.
Great to be
on this Wednesday.
Yeah, we're shaking it up a little bit.
Well, eventually we're going to get back to the Tuesday recording sessions, I guess.
Right. How are you doing?
I'm great.
Good. Glad to hear it.
You know, we were chatting off, so I can tell everybody else. So, had the annual with the doc yesterday, and he said, keep doing what you're doing, and we call that a clean bill of health.
Well, like I said, when I grow up, I'm going to be just like you.
And I said, don't grow up.
Don't grow up. And the good news is I really wasn't planning on it anyway.
Because to be just like me, that's what you have to not grow up.
Not grow up, yeah.
I am 12.
Kind of had that minute, yeah.
I am 12.
Most of us are 12 to 25-year-olds in between the years. So, yeah.
Well, we're here to talk grown-up topics.
Yes, we are.
Like, the reason we call it Taking Stock, we're going to take stock of what's happening in the, the nation's economy, the global economy.
Correct.
I guess,
Yes.
And, we're going to talk about that because, the tariffs topic is going to come up again today. But let's start with some of the news items in the economy. So the gross domestic product.
Yeah, so we got the second revision for gross domestic product for the second quarter of 2025. And it was the first report was 3% growth in the U.S. economy, which is a nice number, and nowhere near the recession number that everybody was worried about still. But then they came out with a new revision, and they actually upgraded it to 3.3% growth. So not only are we not slowing down, according to the numbers, we're still firing on both cylinders, and it's interesting to me that we're looking, and you keep hearing talk about it, and we'll talk about this, but tariffs and other influences having a negative impact on the economy. But guess what? Has yet to show its face.
Well, I was going to ask you because I didn't look at all yet today, and we're at noontime on Wednesday. And I haven't looked at what's been going on in the market today. Yeah. I heard last night late, of course nothing was happening in the market at that hour because the bells rang and everything else at 4 o'clock or whatever. But that aside, the forecast was, well, of course with the tariff news, the markets are dropping. They're going to drop. So what's actually happening today?
So what happened over the weekend is the federal courts came out and said some of the tariffs enacted by the current administration were not legal, or whatever the terminology is, not allowed, or overstepped their bounds. That some of the tariffs could only be enacted by Congress. So the concern there is, number one, is if that is upheld, and let's be clear, if I'm a betting man, it's going to the Supreme Court. So, that's kind of like right now, it's like kind of a yawn, to be honest with you. The markets didn't take it as a yawn, but so it's going to go to the Supreme Court. And honestly, between you and me, in my opinion, is, it's not that big of an event, okay? But here's the problem. The problem is if eventually it is determined that it was not the way to do things, the United States could have to pay back some of those tariffs that were collected, and that would be to the tune of more than a few $1 billion, right? Well, if the government has to pay that back, that money has to come from somewhere, which means we actually have to float more debt, more treasury bonds, more treasury bills, and all that, which increases the supply, which raises interest rates, right? So the concern is, number one, that we're getting all excited about a potential cut in rates, which I'm sure we'll talk about. But here we are that now we're worried about the rates are going to go up because we're have to put more debt out there because the debt's going to have to pay for the tariffs that they say we shouldn't have been collected in the first place. So somewhat convoluted, but that's the reasoning for the market going down. You know, and we were down 1.5% yesterday at one point, and we finished down, I think, 0.69% or 0.68% or something like that. So,
well, you know, we've had some interesting twists when things have happened. They've happened in a very interesting, timely manner. You know, back a couple months ago, we had that thing that was on Friday, at the end of the day. So it's like, you know what, they have the whole weekend to calm down,
right.
and which it did. And then Monday was a little bit more normal, and we didn't have like a crash or something, some significant change. And then this time, with the tariff news over the weekend, it had a chance to settle with a extra day on the weekend because, of course, Monday was Labor Day and the markets were closed.
Exactly.
And so, you know, while you said it dropped, you know, 1.5 on yesterday, on Tuesday when the markets reopened, you know, it's been very interesting to watch how the calendar impacts and, you know, how the weekend impacts the market news, so to speak, or the financial news, or whatever it may be. And yes, we will talk about those interest rates. But what the people couldn't see that are listening to this, since we're not doing video, they couldn't see Chuck over here laughing while you were talking about the fear of a potential rate hike, and knowing that you and I are planning during this episode to discuss the inevitable lowering of the rates and what you feel about that, but let's not launch into that yet.
Well, it's a good thing that this show is an audio show, and you know, because I think I spend half the time with rolling my eyes into the back of my head. So it's probably good that people can't see that. But you're right. We'll talk about it.
They can hear it.
Well, not exactly.
Well, sometimes I bring up, hey, you know, and we're gonna get to a couple other things, but I thought of something important. And it's like, you know, I got to like use gross domestic product, the GDP, growing. Well, there's something else growing with Jarvis.
Is there?
But I don't know if we're supposed to say something or not. That's somebody else's news, and are we allowed to say something?
It is social media official.
Okay.
As of Monday.
Well,
so,
then Chuck Gibson, as the host of Taking Stock with You, would like to say congratulations on the growing Jarvis family news. Congratulations to Caitlin and to Jim.
Yep.
And now we're going to give away the news. I'll let you break what the news is officially.
Well, there's the first grandchild in the family will be arriving sometime in March. So,
awesome.
Which means I can begin to mold the little mind of the third generation of Jarvis Global Investments.
Well, and which also means I can start calling you Grandpa.
Yeah. A lot of people seem to be getting a lot of joy out of that.
Well, you know, the good news, you're just a young Grandpa.
Yeah, so. I like to think that way. No, it's obviously Kim and I are exceptionally happy, and we're looking forward to it. Everybody tells me being a grandparent is the greatest thing in the world, so I'll hold them to it.
Oh yeah, you know, it's a simple formula. Mm-hmm. When you're the grandparent, you spoil the kids and then send them home with mom and dad to deal with.
That I can do.
Everybody knows that.
Yeah.
So, you know,
that would be the easiest job I've ever had.
Count on it.
That's right.
You know, the smile and the laughter right now is just, it's like not even a minuscule portion of how much smile and laughter there will be.
Is that right? Good.
Once the young Gepfrick joins. It's like, I keep saying it's a Jarvis, but this will be the Gepfrick family.
This will be a young Gepfrick.
By extension, Jarvis. But anyway, hey, congratulations to Caitlin and to Jim and to you and to Kim and to all the extended Jarvis / Gepfrick family.
Uncle Austin.
Uncle Austin. Yeah, that's a good one. I like that. So Austin's got his own news coming up. But anyway, so the GDP grew from, you know, a little bit higher than expected with the adjustment from 3.0 to 3.3. And then corporate earnings came out.
Corporate earnings were good. I mean, normally, if you look at surprises on the S&P 500, average corporate earnings surprises for a quarter are somewhere usually in the 70-something% range. We actually finished in the low 80% range. So 80% of corporate earnings were actually surprises. And that was also not only top line but bottom line, so not only earnings, but not only revenue but earnings. So that's another positive sign. I mean, I don't, none of these things I use by themselves, but if you just keep stacking positive news on top of positive news, we got inflation, your favorite PCE, which is the Personal Consumption Expenditure Price Index. I know you enjoy that. It rose a little bit. It went from 2.7 to 2.9%. So, which was a little more than what they were expecting, but we're still under 3%. So, it's you just keep looking at these things. Unemployment's still fine, and it's knock on wood. It's been kind of good news. Now that doesn't mean uncertainty isn't inserting itself into, with the tariffs. The other one was the same time that the news came out about the tariffs, the federal government made a ruling about the National Guard in California also. So they add another little bit of uncertainty to the markets and things like that. So, but you know what? That's what makes the markets go round. If it was, I can always find something to be negative about, but
boy, I'll tell you, we could go off on a tangent if I start asking you questions like, so the crime across the nation, crime in big cities across our nation, has what impact? Well, but then again, we know the answer is fear and greed. So if there's some fear of uncertainty because of crime or rulings regarding how crime is going to be dealt with, so that, that's my answer to my own question.
Well, you look at it from an economic standpoint, the higher the crime, the greater the impact it has on our gross domestic product. Okay? If something negative like that is going on, if people are afraid to go out and spend money, however you want to look at it, that puts downward pressure on the gross domestic product. Now, I'm not saying it's substantial downward, especially since I can pretty much run my life over the internet and have it delivered to my front door anyway. But but even then you have crime. They come to my porch and take it off my porch.
Well,
right?
And I don't know if you got that Ring doorbell or not, but everybody's got the Ring doorbells these days.
Well, apparently some of these guys don't care.
Right?
They'll look right.
Oh no, you get to watch.
Yeah. Yeah, it's like, well, there he is right there. It's like, okay. If you're Amazon or whatever, it's like, either someone replaces the package because of it, so that's downward pressure on their profits, right? Or it's you don't buy it, or maybe you go and buy it again, which I guess equals things out. But again, crime is not a good thing, not only from a social standpoint, but it does have an economic impact. I was in overseas this summer, and people were literally talking about not coming to the United States right now because they were fearful of the crime and the riots. And these are words straight out of people's mouths that we ran into in other countries. And it's like, well, the stuff that you're talking about generally is happening in Los Angeles, California. That's a big city, but it's not that big of a chunk of the United States. You've got a whole other part of the United States out there that you can see. And plus, you're only talking about a small part of Los Angeles anyway. So, it's
1 square mile is the story.
1 square mile. So, you talk about Chicago. They say, Chicago. So, I think it's 4 by 4 blocks, honestly, in Chicago where the majority of the trouble happens. I don't live there, but that's my general understanding. So, but the point is here is, we'll just call it tourism. Tourism is having downward pressure just because of the what the media is showing the world, right? Well, it's like, there's no riots going on in Cincinnati, Ohio.
Well,
right?
this is the best. This is the best way to do it. Here we are on Taking Stock, which as the podcast gets published and put out there, it 24/7 on the internet for the whole world to listen and learn. So we're doing our part, Art. Mm-hmm. We're doing our part to share with the entire world. Come visit the United States. Tourism should be booming. There's a lot happening here that's good. I don't care what anybody says, what my politics is, or what your politics is, or what their politics is. We have a president who has taken note of crime and trying to do something about it. Whether people like how it's happening or not, what the most recent impact was apparently favorable, changed the whole outlook of DC and the crime rate there. So, anyway, for the people out there listening, come and visit the United States. We come and visit you guys, you come visit us, we're all good friends.
And that's what we told them. I'm like, there are so many people come to Washington, D.C., they come to New York, and they go to Disney World, right?
Right.
There's a whole lot more to the United States than those three things. I mean, we have 50, 60 national parks or something like that. There's so many things to see in the United States. You don't have to go to New York City to,
Well, and personally, I would throw in, and we've got great baseball venues all across the country. It's still baseball season for another month, but the National Football League is going to be in full tilt. Come and watch a National Football League football game here. But the bottom line is, you want our money in Europe, and we want your money here. So let's go and visit each other and spend a little of those euros, and we'll spend a little of those dollaros.
Yeah, we'll stay away from the dinars. But and that's I think that's kind of the point with the tariffs, in my opinion. Again, there might be a kinder, gentler way of doing it, but that's not how it's being done. But we have gotten away from what even I consider fairness. Okay, and of course, I can hear my dad in my head go, "Who told you life was fair?" But I mean, it's we have over the last 2-3 decades at least. I mean, I've been paying close attention. We have moved away from what I personally believe is fairness in trade, and it's against the United States. Okay, there are things that go out there from tariffs, but there's also fairness in innovation and things like that. We spend millions and millions of dollars developing something, and then some knockoff shows up in another country, and then really not much you can do about it. So there is some adjustments that I think need to be done, and I think the United States would be better off for it. And I think we've proven over the since February, when we started announcing tariffs, I think we've proven that we can do tariffs and where they actually end up. When we were talking about 250% tariffs, that's probably not a good thing. But where they actually end up, where it's 10% here or 15% here or something like that, that can actually be a good thing for the United States, but yet not crush our gross domestic product, not make inflation go up, not making unemployment go up and things like that. So, that was the big discussion back in February. And, again, we're 6 months down the road. None of that's materialized.
In summation, none of that has materialized.
Yeah.
Which you've taught me a lot, but if nothing else, you certainly taught me fear and greed.
Yeah.
And so, nothing has materialized is the summation of that. But man, what was the fear and greed factor at the start of that in February?
Well,
right?
I mean, the media beat that horse to death. So, and this is a life lessons from Art Jarvis. I'm not sure anybody should take them, but
Chuck just walked out.
That's right. But take fear, the fear in your life. I mean, there's some fear that keeps you safe, right? But take the fear, lock it in the back of the closet, and go on. You're usually going to end up better off if you don't let fear shut you down from the things that you're trying to accomplish, right? Are you always going to be right? No. But in general, you're probably going to do okay.
I would use, instead of fear, it's like respect the risk.
That's good.
So there's the life lesson from Chuck. Yeah. We should, as you just said, you can't. I mean, if we thought about all of the things that we could potentially fear, you don't walk out the front door of your house. Right. You just lock yourself down. And sadly, we know there are people who's, are crippled by such feelings of fear. Respect the risk. Yeah. there might be a car coming, don't run out in the middle of the road. I mean, there's some simple things, but
or just trust that they'll slam on the brakes. Yeah.
Well, the cars do that now without us, because they
do it themselves.
So we can just run out there.
I like the way you said it better. Respect the risk.
Right.
Okay, that's true. And I mean, how many things in this world have not been accomplished because someone was afraid of the ridicule or things, people putting them down or making fun of them or pick something. How many things have not? I mean, we're all guilty of it.
Right.
And if you can take that fear, shove it off to the side, and make an educated decision about something, and that's you mentioned it earlier. It's you talk about having that extra day, like having Monday to kind of sort through things and dissipate the uncertainty and go, okay, man, that sounded really bad at first, but this could be done and that can be done and this can be done, and guess what? It's not as bad as I think it is. So,
well, as a working member of the media, as somebody who has been, in journalism, this is 41st year for me. I hate to do this, but I'm going to do it anyway. The media. So respect the risk, and as we just talked about. Well, and you said, make an educated decision. That's where the media can play a huge, very important, and very positive role by, not doing the fear-mongering report, or the biased reports, but saying, what, here's what's happening. This could result from it or that. Not just like crawl under the desk and scream. Mm-hmm. So respect the risk, but let's have somebody help define what that risk really is.
There you go. Exactly.
I'm standing on the side of the road, and I shouldn't walk out into the road because I could get run over by a car. Well, when you look down the road, and it's a nice flat, straight road, and as far as you can see, there are no cars. I think you're all right. Go ahead and walk across the road. But, respect them. Now you're standing at the side of the road and, you can see a car. I would suggest the risk is high and you might want to stay on this curb.
Yeah, you want to mitigate your risk.
Right. There you go. But anyway, that's beating that horse to death. Yeah. We definitely wanted to talk. You were like a horse chomping at the on the interest rates.
Yeah.
And then the funny, again, I still can't get over. I was sitting here laughing, and the people couldn't see me, but I was sitting here laughing when you're talking about the concern about a potential, that could cause, higher interest rates. Right. Well, but the key thing is right now, what we expect is inevitable is a lowering of the rate during this month of September.
Right. I mean, it's almost a foregone conclusion that we're going to get a rate cut here. Right. I think it's September 21st, 22nd. I think right in that week somewhere. And it's almost a foregone, which caused the problem yesterday, because then it causes a little uncertainty that we might not get that rate cut that we've been already assumed we already got, right? So even if we get it, what's the reaction going to be? Probably pretty nil, because we've already priced it into.
See, so first of all, lower interest rates is not going to cause a major reaction because, again, the information's out there. The education process is already happening. It's coming, and what will it do? Yeah. So the reaction should not be a strong reaction to lowered interest rates.
Right. So it's not. If they lowered rates maybe 0.5%, if they lowered rates 0.75%, guess what? That's a great big huge surprise, and the market's going to react accordingly, and and it'll probably be a lot of whipsaw because some people are going to be really happy about that at first, and then other people are not going to be, such as myself. It's again, we spent. Interest rates are good. They're not as good as they used to be, but they're good, and I still feel they're appropriate for where they are. Okay, the economy is humming along. Inflation, which we've spent a good chunk of 3 years beating back into the barn, again, they're below 3. We're at 2.7 or 2.9. Okay, so but the federal government or the Fed wants them down to 2. like as we've mentioned for the last 2 years, I believe, it's going to take a lot of work to get interest rates to get inflation down to 2%. Okay, it's it's like,
well, we've been talking about it for 2 years.
Yeah.
It's like 2.7. So.
And here we are, right?
Yeah, right.
So, but here's the problem. Once again, when you lower interest rates, that is the equivalent of pushing just a little bit harder on the accelerator, which makes things go faster. So let's say now you're making the economy go faster, and I understand the desire to have the economy firing on all cylinders and running fast. But the problem is you got to keep an eye on the inflation, okay? And I guess the best way to describe it, we've kind of come to a standstill with inflation a little bit. So if we're not in a declining interest rate environment, why increase interest rates? When we're doing okay, but they're not working their way down. So again, that's a very long-winded way of me saying, I just don't think they're needed. Again, I've said it several times. Give me all the 3% money you're willing to give me. I'll take it all, right? But I know a person who just closed on their house, and they're at 5 5/8%. Wow. with some points. So is that rate 3%? No. But is it 10%, 12%, 16% like our parents had? No, it's not. Again, if I had 5%, would I rather be at 3%? Most certainly. But the problem is then you go into the housing market, and I'm not sure how much time we have left here, but you go into the housing market, you've got two problems. You had interest rates go from really almost like 2.5 to 2.75% up to 7%. Yeah. Okay, but at the same time, you've had housing values just shoot through the roof. So, and you've had the demand for housing increase at the same time, right? So now you've got all these people who really weren't interested in buying a house. Now all of a sudden, as a demographic subset, all of a sudden they want to buy a house. Well, they waited until interest rates went from 3% to 7%, and they waited for the housing values to go up 50, 60, 70, 80%, right? So there's the problem in there. It's like, well, I want interest rates down so people can afford a house. Well, okay, that might make it easier to afford a house, but guess what? That's going to make the housing values go up even further. Okay, because now you got even more people trying to buy a house because interest rates are lower. And if you're lowering interest rates, does that mean that your other expenditures are going to start to go up? So are my groceries going to start costing more? Is my fuel going to start costing more? Is my insurance going to start costing more? Are my real estate taxes going to start costing? Is everything else that I have to deal with? So that's great that my monthly house payment is less. But if I'm saving $100 on my monthly house payment, but I'm spending $200 more on groceries and gas, guess what? I'm losing, right?
Right.
So that's why I kind of get on my high horse about, I just don't think it's time to lower rates. But we've got this discussion, and certain individuals want lower rates no matter what, and I've had.
Well, you don't have Powell's job.
No, I don't. And we'll leave it at that. I hear it might be old enough.
No, you know what? This is why I opened that can of worms and said we talked about it a little bit, and we wanted to. You were chomping at the bit to talk about this interest rate situation, and so anyway, you stand very firmly in the corner of basically you're happy to hold steady. We don't need a lowering. Although you kind of hedge a little bit, say, if it's a half a point,
if it's a quarter point, it's all. I mean, I hate to say it like this, but it's almost I don't care a whole lot. But here's the problem: they lowered a quarter. Do the banks and everyone follow suit and actually lower interest rates in the mortgages by a quarter? What happens if they don't move? It happens. You can get a lower interest rate. You can have them the Fed lower rates, and the mortgage rates don't move. So great now. So raising or lowering a quarter point, is it gonna have some astronomical impact? No. Is it needed? In my opinion, no. So why mess with it? And here's the other thing: why lower? We've already talked rates down a quarter point. They don't even have to lower rates. They've already lowered them just from job owning, right?
See, that's the most solid point regarding this whole situation. The Feds don't necessarily have to make that move to create it, like you said, with the mortgage rates and so on and so forth. But you know what? We've come to the end
about that. That was
of
nice.
Taking Stock 56. Probably a good place to end, but a quick recap. We talked about the gross domestic product up. We talked about the corporate earnings up. I have some more questions about that, but that's for another episode.
I'll see you in 2 weeks.
Well, and then the inflation, we discussed a little bit about what's going on there. And closed off with a really strong dissertation.
Sorry about that.
No, that's good. That's why we wanted to talk about it. And I think it's great that you're sitting here, and that we have you, Art Jarvis, to talk to the listeners about what this whole interest rate, what the impact of it really is.
Right.
And it's your opinion, but
sure.
It has 35 plus years or something like that.
Yeah, I'm more than that.
Support.
Yeah, here's the problem. I've spent the majority of my career looking at things from a contrarian standpoint. Okay, it's true because I say all the time, if everybody's on this side of the boat, I want to be on the other side of the boat. Okay,
right.
So it has served. The problem is it served me well. Okay, if everybody's over here saying this and thinking this, the right answer is probably not over here. It's probably over on the other side. Okay, so this is the thing. It's like Y2K. They beat that horse to death, right?
Right.
Everyone's over here worried about it, talking about blah blah blah. I'm over here going, it's already taken care of.
Yes.
Yeah. So.
And it was.
Yeah, and it was. So it's that's one example. But I've stated my piece.
Well, we'll find another horse to jump on.
There you go. Well, they'll provide one. I guarantee you.
Actually, it's going to be in 13 days because I think we'll be back on a Tuesday track as we wrap up episode number 56 of Taking Stock. Art Jarvis, thank you once again for your time being with us and for your point of view.
Yeah, thank you, Chuck. Have a great one.
You too. Thanks. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.